Hey, good morning, everybody. It's Jerry Maniak here. Happy Monday. We're going to get the call going here in probably about a minute here. Just waiting for a few more people to get in here, but we'll go ahead and get the call going here in just a minute. So hold on tight. All right. Well, good morning. We'll get things rolling here. So again, happy Monday. Couple of housekeeping notes. Housekeeping. So coming up here, this will be our last call for 2024. So I'll give you a bad dad joke. See you guys next year. The call on the 23rd, which is right before Christmas. We will not be having a call then, and then we're not going to have a call on the 30th. So our next call together will be on, I believe, the 6th of January. So you guys can go ahead. We'll have a little vacation there. In terms of some hours and whatnot, so next week we will be open on the 23rd. So whatever you guys are working on, ECA is happy to help you guys out with. We're going to close at 2 o'clock on the 24th, which is Christmas Eve. And then we will be open on the 26th and 27th. And so kind of similar for the following week too as well on New Year's Eve there, which obviously New Year's Eve will close early at 2 o'clock, and then we'll be closed January 1st for New Year's Day. So exciting stuff. Enjoy your Merry Christmas, you guys. Enjoy your time with your families. It's always fantastic. So kind of starting off, actively managed funds versus passively managed funds. What usually ends up doing better for people? What ends up getting more return? Now, if you said passive funds, I would say you're correct most of the time, and I get it. Sometimes there's been this debate for a long time, on what actually made more sense or what was actually better. I think the jury's really out that passively managed funds end up doing better, and there's a number of reasons. We'll talk about some of that today. But there's one type of passively managed fund that works better than kind of some of the other ones out there, and it's a little bit funny, honestly. Rest in peace. It's called a managed fund, a passively managed fund managed by a dead person, and I'll get into why I say that actually. So Fidelity reviewed which investors did best. I'm sorry, what's that? Allie, can you hear me?
You're still, yeah, I can hear you, but you still have the have a great session on instead of your PowerPoint.
Oh, let's see here. What is going on here?
Sorry to interrupt.
No, that's okay. It's showing. Stop sharing, view tab. Okay. Let's see here. How would we do this here? Okay, so it's, let me fix here. Just browse, share tabs. So I'll have to change my share here again because it's sharing just in there. Share screen, entire screen. There we go.
Perfect. All right.
Okay, sorry about that. Thank you. Thanks for helping. Now we can see it, correct?
Yep. Sounds good.
Okay, beautiful. Appreciate it. No, thanks for interrupting. You're doing a great job, like Missy would always do, to pop in there. So let's see here. Beautiful. There we go. So now we can see it. Sorry about that, guys. Thanks, Allie. You saved the day. So actively managed versus passively managed funds. This is what you guys missed here. Rest in peace. So a dead person was actually doing a better job. So here's what I mean by that, catching guys up. So Fidelity reviewed which investors did best, and they wanted to go in, and what they found was pretty funny here. So they did an internal study. What they did was they went through and they're looking at all of their accounts that they had and seeing which ones were doing best. And they made phone calls out, they did interviews, and what they're trying to do is they're trying to look and find out what are the strategies or the technical indicators what were those, what were the buy sell trends? What were the sectors? What were these things that these people are doing that made them so much more successful than all the other people that are with Fidelity? Because there's so many different people on there. They wanted to gather data and information to figure out what it was that these people were doing. It was actually pretty amazing. Set it and forget it isn't investing isn't sexy, but it works. In fact, lazy investing is so effective. A study from Fidelity, so Fidelity we were talking about, found that the best performing investors had either forgotten about their accounts or, even crazier, they were dead. So they didn't even, in this study here, they didn't even put out there and say, hey, here is the sector that they were in. Here's they're in energy or they're in healthcare or anything like that whatsoever. It didn't even matter where they were at. Not enough to the point that they even published it or talked about it. The point that they made was it really didn't matter what they were invested in as long as they set it, left it alone, and just let it go. These people, they ended up doing better than any of the other investors and people out there. And it kind of goes into a little bit about what I talked about a couple of weeks ago when we were talking about Warren Buffett. These people are unintentionally kind of doing it by being lazy and ended up being better for them. In this case, it ends up being a little better. But like with Warren Buffett, where he looks at companies, he looks at technical indicators, finds businesses that he thinks are going to be good long term, buys them, and then they end up doing a lot better rather than worrying about annual rate of return, which can get you into some trouble. Here was another study out there, asset class returns versus average investor. And kind of interesting here, so you had all these different sectors, and this is over a 20-year period here. And the market's cyclical, so this stuff just continues to repeat itself. But all the way down here, average investor, behind everything. And your average investor, if you look at it too as well, why is it that happens? Why they end up going back to it? What are investors interested in? Rates of return. And so when you're buying, whenever the market's up and getting excited, and they're selling when the market's going down, that's how the average investor ends up getting knocked down between that period of time. And average investor doesn't just include your random do-it-yourselfers out there. What they're talking about is most investors, the average investor has an advisor that they're dealing with, and this is how far under they underperformed on annual rate of returns as compared to a lot of the different sectors. So it goes into, a lot of times just the simple benchmarks that we're talking about out there just end up performing so much better by, just removing all the guesswork out of things. And that's kind of one of the big ones that Mike's always talked about is don't make promises you can't keep. And that's a great way. I mean, it seems like simple advice. And that's one of the items, not making promises that we can't keep. That's one of the ways to best keep clients too, as well as only do things that we say that we actually can do. And I think sometimes we get money managers, people that we're dealing with, or maybe even, but two of the things that we always talk about that we are promises that we don't want to make or promises that we should make because we know we can keep them is, first of all, we never tell people that, if the markets are going up, your money's going to go up. If the markets are going down, your money's going to go down. Anything beyond that, I have absolutely no control, and I honestly can't promise people. Those are things right there, and Mike would always say this, that's something that I can bet my house on. And when I'm playing with people's retirements, I shouldn't be putting in people positions or making promises of things to lead them to believe I can do more than just that. And if I pound these things into the heads of my clients that this is how it's going to work, but we're going to have a plan and a strategy that works in both areas, which I can talk a little bit more later, then we're not going to be in having any problems with clients. And we're not going to worry about when the market goes down, we're not going to have clients that are frustrated with us anymore. But there's nothing more than we can truly, really promise or should be than when the markets are up, our accounts are going to go up. And when the markets are down, our accounts are going to go down. Now, there was for a while, I think that's kind of been something that's kind of been, there was another, my money manager won't necessarily give all the upside. However, he's going to protect some of the downside risk. Now, I'll tell you, there's probably a few kind of issues I've heard that out there. But one of the things that we used to talk or used to hear about years ago all the time was, active money management beating the benchmarks. I think that's pretty much been kind of debunked. Everybody kind of knows that by now. But here's one of the conversations A money manager won't necessarily give you all the upside, but he'll protect you from the downside. And don't get me wrong, guys, when we're going through this, obviously, I think one of the big things that I like about 5Q Group and what we're doing is it's not about these things aren't in comparison. What I'm going to get into is how they can kind of work together in a little bit, but I just think it's also important to understand, and from time to time I'll hear people that get overly excited, that feel that their money management platform is the end all be all and they don't have anything to worry about. And I think that a healthy portfolio is when you blend fixed index annuities together with money management, then we end up having a very good marriage. And there's a lot of good reasons for that. I'm happy to kind of continue to jump into. But one of the issues here, and this is, a promise, talking about two promises that you want to make and promise you don't want to. I think this one kind of falls in for a couple of reasons. A promise I don't like to make, that they're going to help me out on the downside. And there's a few reasons for that. So, will actively managed funds outperform index funds? The huge flows into index funds and ETFs has been in large part because of the futility of active fund managers. Efforts to outperform their benchmarks. One of the arguments from active money managers is that while they are falling behind in the raging bull market, they are sure to provide cover and outperform when it reverses course. According to data from Standard & Poor's, that wasn't the case during the last two bear markets. So this says right here, percent of active funds outperformed by benchmarks in the market. So right here, 54% of the time in these, all large cap funds were outperforming active money managers. And then, we have 08, 2000, 2002, we're up in the 83% of the time they're outperformed, 71. What it's really showing here, granted, yeah, there are some times where they did do better. That's what they're showing. But the majority, if I'm betting, if we're looking here, of the time, benchmarks outperformed actively managed funds. So what it's saying there is no, for the most part, on the downside, they're not doing better than the benchmark. So, that kind of leads to B, and that's what brings the question to mind with clients is then when that doesn't happen, then you made a promise you couldn't keep, and then clients are frustrated. It's just like, and besides from a practical point, I would say as well, I'm not sure how it actually really plays well with a client, even when it does work out that way. Because if you have a client, if the market was down 25%, your client lost 15, and they're frustrated about that. And especially we're talking about people that are in retirement, right? It doesn't matter as much when you have people that are 20 and 30 and 40 years old and haven't retired because they have time to make that up. But when people are in retirement, it makes such a big difference. But how does it play when they're in retirement? Because if you go to your client and they're like, well, I lost 15%, you say, well, Bob down the street, he lost 25. From a practical matter, it doesn't really make him feel any better. And that's what we were talking about the other week when I was on the call too as well. Whereas, it certainly making more money doesn't necessarily make people's lives. It don't change how they're living, but certainly losing does. And so saying, hey, you lost a little bit less than the other guys, I don't know that it really necessarily plays that much better with a client. So that's a promise that I don't really like to make. And I think it's better off if we don't make promises that we can't keep. Michael Kane here. I'll always be there because I am a skilled professional actor. Whether or not I have any talent is besides the point. I like this quote. I think it's funny because really, there's professional money managers that have been doing things for a long time, and they may say things, but it's really your job to understand your clients and look out for the best interest because, you know what, they're professional money managers, and it's their job to build your confidence inside of their funds and what they're using, and that's their job, whether they actually have real talent in it. And besides the point, there's a lot of money managers that are out there, and they come and go, and it's always interesting how new ones pop out after you have a market where everybody gets crushed and they change funds and things like that. But if people were really that great, this is why you guys are smart guys. I'll tell you, half of you guys are probably as smart or smarter than some of the money managers that are out there. And the reason why I say that is if they're really that smart, how big would their average client be? Mike always quoted this, and I found it very true. How large would their average client be? Because if they could really do that as well as they claim they do and have the faith in that, their minimum average client size would not be 500 grand. It wouldn't be a million. It wouldn't be 200 million. It would be 100 million. Long-term capital management back in the 90s, they were that good. they were that good until they weren't, and their minimum client size was like 100 million to be able to get in there. So kind of getting into the point of the call a little bit more as well. Like I said, there's a great way, I think, where fixed index annuities and managed monies, where they really blend and they kind of come together in a beautiful way. In many different ways. I think in terms of what's great for client and getting them a solid return and eliminating some of the risk in retirement, which is obviously important when people start taking withdrawals. And then also as kind of with advisors and building practice, I think having that trail compensation that's coming in. I've always told guys this. And then having the upfront compensation. And a lot of guys always worry on the upfront compensation. They're like, oh, I'm one time and I get it and it's not there. We all know this. Typically when you're writing fixed index annuities, there's always a period down the road where you're able to improve or replace or various things like that happen. So it's never a one-time sale, which is great. And we all know that, and that's good for clients. That's why we take care of our clients in a good fashion. So what's the best asset allocation? So we kind of went over this a couple of years ago. I find it, some people may not know this or seen this. We have new people that are on the 5Q group, but I think it's it's always good to remind ourselves too as well, because sometimes we end up kind of just having that reminder to stay kind of right in our lane of where we should be thinking, and having those reminders are good for us. So you guys will probably remember when this came out, Roger Ibbotson, Yale School of Management, real smart guy, big stock guy. So a professor in the practice of emeritus of management, Roger Ibbotson. He's the chairman and CIO of Zebra Capital Management, huge hedge fund, equity investment hedge fund manager, wrote a ton of books, big time stock guy, very well known. We all know him. He's kind of a scholar in the business. What did he have to say here? So what's most relevant to you is whether and how you're doing something different from what everyone else is doing. Pretty good advice. So anyways, he had a wealthmanagement.com. There's a number of places, but wealthmanagement.com, you guys can go look it up. They actually published this article from him. And what he's talking about is fixed index annuities beat out bonds. And so in his latest research, economist Roger Ibbotson argues that fixed index annuities have the potential to outperform bonds in the near future and smooth the return pattern of our portfolio. This was back in March of 2018. And the article holds great truth today. He's a very smart guy. But this is how we use, guys. I mean, this is how we use fixed index annuities. And I think using that, income riders have been great. By the way, when he wrote this article too, fixed index annuities were in a very, very low area in terms of interest rate, but they're still beating out bonds even that time. But he looks over a long period of time. But I'm going to get into that in a little bit here still, though. But I just think that it's important to continue to remember. And we have guys, and I think some people, get overly, I don't know what it is, but I still run into people that I'll give them a call and I'll chat with them, and they'll have managed portfolios, and they'll have clients that don't have fixed index annuities in their portfolio. And it could be for whatever reason, but this is where, I'll ask them, so, okay, you have managed money. Well, do you have moderate portfolios that put people in? Well, how much of that is bonds? Well, maybe 40% that's sitting in bonds still. And I just asked them, why would you do that? And this is something kind of addressing that, but you can get more return with a fixed index annuity. Instantly, you're able to eliminate those fees for those clients by, say, if you remove the 40% in bonds and put them in fixed index annuity, you'd eliminate the 1% fee that they're getting on that account. So you'd eliminate their fees by 40%, and you'd increase their return. Now, I get it. There's a trail. If you're wanting those trails, you're thinking, hey, I'm going to lose that trail. Not really, because you could go ahead and use an FIA with a trail on it, and then you eliminate the risk of that account going up and down on your fixed index annuity side as well. But even better, I would say take the upfront and then use those dollars to go do some marketing, and then every 7 to 10 years you're able to go and replace and write that stuff anyways. If things have obviously gotten better, but that's kind of not the point. But I run into it from time to time, so I think it's good to to pay attention. But also I think sometimes we don't want to rattle the cage with clients. So it's like, why would I go do this? But Roger Ibbotson is just going to talk a little bit about here, go through why it makes more sense and why FIAs do a better job there. Ibbotson's seminal work was around the idea that as you take on more risk in a portfolio, you get higher return. Well, that's good. That's what we have in our we want to have happen. And when we look at our plot chart, we hope that that's happening when we're working with new clients. But the risk is volatility. And as one approaches retirement, they can't afford the lack of stability. And so stability obviously is much more important in retirement, like he's saying, because we're now taking withdrawals off of our accounts. And so many times we like to ignore the fact that this is important. So interesting here in the white paper, fixed index annuities, consider the alternative. Ibbotson and his team at Zebra Capital Management ran hypothetical returns simulating from 1927 to 2016 and found that net of fees, fixed index annuities had an annualized return of 5.81% compared to 5.32% for long-term government bonds and 9.92% for large cap stocks over that period. And this is a period of both rising and falling yields. So he's looking at all situations. So annualized return, we got it right here, 9.92, 5.81. So it didn't beat it out a lot, but there's a heck of a lot less risk in FIAs and bonds. Standard deviation, obviously they're pretty close here. You don't have to worry about negatives with FIAs as you do with bonds and large cap stocks. And then maximum return here on a 3-year period, really even stock didn't outbeat it out too hard here. So, but that's not kind of really the point. FIAs were beating out bonds. That's kind of the point in the study that he did was, that's what we really look at. FIAs as a bond alternative. Okay. It's to not lose money. It's to make clients be able to go into retirement and live a lifestyle and not have concerns about what happens in their market. And quite frankly, it's for you as an advisor so that you can manage money for clients and be able to take care of clients and not have to worry. I honestly kind of look at it a little bit. I have guys that come with me and they'll talk about RILAs. I have no problem with RILAs. I think RILAs can be a great product for people, but it's still a buffered product where you can lose. So with RILAs, I look at RILAs really fitting into the equity side of a portfolio, not as a replacement for bond or replacement for FIA. I know a lot of wholesalers will come in and say that, but I think the last handful of RILAs I talked about with advisors, they got it in the zero loss portion of it, and they're telling me they're at a 7 or 8 or 9% cap on it. Well, you can get FIAs with the 10, 11% cap with no loss on it right now. So I would go with the FIA on it, but I'm just not a huge fan of buffer right now. I'd rather just use a stock. That's kind of besides the point. I'm going off on a tangent, but so at the time, treasuries, had been kind of going down. Right now, we're probably sitting right around in here, so it's great because the interest rates have gone up, but it hasn't really mattered because, it didn't matter where things were really at. We're in the highest interest rate environment back here in the 80s. That's what the study was looking at. Didn't matter where we were at on here. And to be quite frank with you, when interest rates are that high, God, I can't imagine where the caps were. We probably had ridiculous S&P 500 caps. Ibbotson also simulated different portfolios and how they would perform in below median bond return environments. So like we had in like 2016, which he believes we're heading into, versus median bond return environments. During below median bond return environments from 27 to 16, 60-40 stock portfolio, the portfolio returned 7.6% on average, the old 60-40 portfolio. That compares to 8.12% if we did a 60-20-20 stock bond fixed index annuities portfolio. That's good. We got a little bit better. We put some in there, but even better portfolio, 8.63% for a 60-40 stock and fixed index portfolio. So what was Ibbotson saying? And annuities were kind of the red-headed stepchild for so long, and now the stock world, the big banks, everybody's kind of taken notice, and annuities have gotten better or worse since when the study came out. A lot better. They've gotten way better than they were here. And at this time, what was Ibbotson suggesting that we're using? FIAs. So preaching the choir with many of you guys, but using that portfolio, 60/40 stock to fixed index annuity or managed money portfolio. What he's not talking about here too is part of this is eliminating the fee on the fixed index annuity side, where there's a fee on the bond side. So it's even better than this net of fees on that. So for those of you that are out there that haven't replaced that bond portion of the portfolio yet and use fixed index annuities, now's a great time to start looking at that and doing that with your clients. So let's take a look here. So these are the kind of the different environments: below median and above median bond return environments. So in the below median bond return environments, kind of average return, we got the long-term government bonds, 1.87, large cap stocks for killing. FIA is a little better, 4.42. And then here's the portfolio: 60/40 stock bond, 7.6. We got the 60/20/20. Again, here's the 60/40 that Ibbotson's making note that we should be using as the portfolio. And then right here in the median bond retirement, okay, here we go. Bonds outperformed it. They did. A little more risk in bonds, but I don't know that it's that much more to, in that ridiculous environment back in the 80s, to really write home about. And then here we go. Here's the average overall, but we have less risk. So the 60/40 stock to bond, pretty smart guy that feels FIAs should be in there. Using bonds, basically FIAs basically give you the bonds anyways because they buy so many of them, except for you get that additional protection from the insurance company, and you end up getting a better rate of return too as well. So 50/50, that's what we talk about. 60/40, I think that's good. 70/30, somewhere there, got I think better than 100/0. I think depending on the clients, especially as we're getting closer to retirement. There's a million studies out there we can do and believe and do whatever that we want. I think that there's a lot of great studies out there, and with FIAs getting better too as well, making sure that we're in that position of 60/40, 50/50. Maybe in some cases it might be even better, but I think there's a lot of smart people in academia to support, especially using FIAs instead of bonds. So here's a chart we've all kind of seen here too as well. And I think it's funny, and this is just one period of time over a 20-year period, but it's a pretty darn recent period in time. Talking about fees versus net of fees, how they actually affect you. Here's the S&P 500 since 2000 to 23, and we're including those two negative periods in here too as well, right? S&P 500 with no fee, 100 grand starting, 322 grand over that period of time. No withdrawals coming out either, mind you. The fee, so this is why I kind of talk about the fee if you remove bonds out of a portfolio. We're just talking S&P 500, so at least we're talking about a very passive account. So if we can remove fees, look what the fee does. The fee knocks the account down by 25%. I don't know what, maybe my math ain't so great here, but quite a bit by having that fee. So reducing the fee on the account by removing the bonds out is going to make a big difference here. But 255 over that period versus 322 versus having the 1% fee on there. 40% par rate. So if we do an FIA, we're just sliding this in here. We did the same exact thing. 100 grand in here, 40% par rate, no losses, 283, no fees. Actually beat out the S&P 500 during that period of time. Set it and forget it, right? At least the nice thing you have on your S&P is we're just showing sitting here instead of buying and selling and all the other goofy things we do sometimes. This is just setting it and forgetting it, which were the best performing accounts according to Fidelity. We got the trigger account. We had a 9% trigger. I'll probably update this here. I'm not sure we can quite get the 9% anymore, but we'd be up to 397 on a 9% trigger. This we can get. We can actually do better than this. 10% S&P cap actually did the best. Set it and forget it. So you can set it and forget it in FIA, 3.99%, or 399,000 on 100 grand here from 2000 to 2023. So I think FIAs are definitely in vogue, and I'm not suggesting that you go out and place your entire equity account, but I think bond, I think it's pretty clear that it makes sense to be able to do that. And then kind of just wanted to show you here. So with those rates there, and I even think, if you're using RILAs with 9, 11, 12% caps, but they have downside on them still, why even do that? Here's Delaware Life Target 10 Growth, just to show you. I just happen to be flipping through. There's a number of products that are here like this. S&P Performance Trigger, just to kind of show back on what we were just looking at on this sheet here of what we can get. So this is a 40% par, how it did. 9% trigger, 10% cap. This product all in one, Delaware Life's Target Growth 10, 7.9% trigger. So it's pretty close. We got a little bit higher S&P cap here if we're at the 100,000 plus threshold, 10.5% S&P cap. They got a 55% par rate. So no cap, 55% par rate. So FIAs are crushing right now. There's some great products out there. Many of them along with the Delaware Life Target Growth 10. If you guys haven't gone through and made sure that you replace that bond portion of the portfolio, that's a great place to go in. It's great news when you call a client and say, hey, I got an idea to share with you guys on how we can reduce your fees and pop your yield up. I know we had a ton of people. We had a letter that we had that some guys had sent out to all their clients, followed it with a phone call. That worked pretty good if you guys were looking for that letter, or excuse me, guys. If you're looking for, for that letter, or obviously the replacement still from annuities that were 3-4 years ago, that's great too as well. Happy to go through how some of that's working with you. There's a lot of great ideas and things that guys are using. The Roth conversion is crushing. I've started to have more and more guys going and kind of using that strategy too as well. So some great strategies. Love to chat with you guys. There's a lot of ideas and stuff on the marketing front. We're working on some things too as well that I think will be exciting coming out here in the near future. But there's a lot of great ideas and things that you can do. Birthday parties. There was, the client advisory events. A lot of ways to get in front of it. I'd love to sit down with some of you guys and go over what you guys are kind of planning for marketing to get in front of people. But a great instant idea is obviously the Roth conversion strategy. We talked about that. Making sure we're all set in the bond area, and then replacements too as well are always there too as well. So, and happy to hear your ideas too as well. But that's what I kind of had for you guys. Thanks for your time. Thanks for letting me be on my soapbox for a little bit with you too as well. I appreciate every one of you. I enjoy talking with you, working with you guys on your practices and what you have going on. And have a Merry Christmas. Enjoy the New Year. And feel free. Happy to chat with you guys anytime. Have a great rest of the week, rest of the year. And we'll see you on the next call. Mike will be I'm on that one. I believe that's the 6th. And we'll chat with you guys later. Thanks a lot.